Thank you so much for attending today, and thank you for our amazing panelists. So we're going to dive into the future of private equity and venture. And just by way of introduction, I'm Shifra Ansonoff. So I run the customer experience at Preqin, a leading provider of alternative data and insights. And my entire career has been in financial technology through my time at Bloomberg, BlackRock on the solutions side, Axioma, and now coming back to BlackRock through Preqin. To my left, we have Michael 𝐏𝐀𝐍𝐄𝐋, who heads U.S. venture capital for Moray Asset Global Investments. And he has over 11 years of experience. He leads the investment strategy for one of Asia's premier financial institutions, managing over $600 billion in assets. And Michael partners with innovative companies like 𝐏𝐀𝐍𝐿, 𝐏𝐀𝐍𝐿 to empower them in disrupting industries and driving lasting positive change. Next, literally, we have Greg, who co-heads Next Investors, and he's been with the company for quite some time. At Next, he's played a pivotal role in key investments, including iCapital, May Street, as well as Secure Islands and TradeWeb. And prior to, Greg has been with Credit Suisse, where he focused on direct private equity investments. To his left is Lisa Sun, Managing Director and Co-Head of BlackRock Secondaries and Liquidity Solutions. Lisa is responsible for the investment strategy, deal sourcing, execution, and portfolio management. She's also a member of the SLS Investment Committee, and prior to was investment principal at Caller Capital, focusing on secondary deals across various structures, then before TPG and before Goldman. Next, we have Lee Gardella, who heads the private equity North America arm of Schroders and oversees the firm's investment, risk, and monitoring efforts as a member of the investment committee. And prior to Schroders, Lee led the private markets group at CTC Consulting, the family office advisory subsidiary of US Trust. And Lee has extensive experience across private equity, real estate, and hedge funds. And finally, last but certainly not least, we have Laura Black, who brings over 25 years of experience in both the public and private sectors, including 15 years at the US Department of Treasury, where she served as the first director of policy and international relations for CFIUS. And in her current role as senior counsel at Akin, Gump, Strauss, Hauer, and Feld, Laura now provides strategic guidance to clients, including funds and multinational corporations, on investment screening with a national security context. So to kick us off, I want to start with some forecasts that we have at Preqin. So our flagship publication, Futures of Alts, is one that we released the last few weeks, where we predicted that total AUM for alternatives, standing at $16.8 trillion today, will reach almost $30 trillion by the end of 2029. And private equity is seen as the fastest growing asset class in terms of AUM, growing from $5.8 trillion to $12 trillion at this time. And a big part of this growth that's anticipated to come from private wealth. So much so we're hearing talk of a convergence of public and private markets. And in a recent earnings call for BlackRock, Larry Fink went so far as to say that private markets won't be alternatives anymore. So this question is for Lisa and Lee. Can you describe the part of the industry you sit in and talk to the extent you agree with the bullishness of our estimates at Preqin, and how you expect increasingly active private wealth investors to impact the part of private markets businesses you operate in?
Okay, thanks for that, and thank you for having me on this panel. As it relates to the comment by Larry in the BlackRock earnings call, I think when we think about where I sit, I am the co-head of our Secondaries and Liquidity Solutions team. Essentially, what is a secondary is where we offer liquidity to illiquid assets, like private equity, like venture capital, like private credit. Essentially, any asset class where investors, typically institutional investors, historically have invested into a fund structure, and over a period of time, the desire for distributions and exits might be different than what the company needs. This is where somebody like us and our team can come in to provide that liquidity. And so when you think about the question regarding private wealth, the big theme in the market is really this convergence of public and private market, both On the capital raising side, i.e. historically, it's been institutional capital, public pension plans, sovereign wealth funds, endowments and foundations that have invested into privates. And now clearly a lot of retail capital, whether it's through 40 Act funds, semi-liquid vehicles, evergreen, are coming into that. So the type of investors coming into private assets is different. And then on the capital formation side, that's capital formation. On the capital financing side, historically, public equities or public market is where the end-all be-all is for companies. But today, as private companies are staying private for longer, they're just needing more capital from the private markets rather than the public markets. So when you have those two convergence themes, and when you start to see more retail capital coming into private markets, the desire for liquidity, the desire to see what's happening in the private markets, similar to what you see in the public equity markets, exits or secondary exits, the trading of stocks between you and me today as secondaries, we will start to see that trend becoming more and more prominent in the private markets as well.
Yeah, I'll just try to build on that answer. So in our view, the growth in private markets and specifically private equity incrementally is going to come from private wealth. It is today. The institutional investor is a mature investor for the most part. And to get to that $30 trillion number, it wouldn't come only from institutional investors. It has to come from private wealth marketplace, but also smaller institutional investors. And the reason why that is the convergence of several things that are coming together. First and foremost is these smaller investors who've dabbled in private markets, but have not enjoyed the experience because the typical LP structure is not made for smaller investors. It's very arduous. Through product innovation and regulation updates over the years, you're seeing products in the marketplace, both here in the States and offshore, that are allowing individual investors easier access to private asset strategies, in particular private equity. Secondly is technology. If you marry technology along some of these product innovations, it further makes it easier for for the advisor to make a decision, for the client to understand its exposures. So think of technologies in firms like 𝐏𝐀𝐍𝐄𝐋 and CASE and some of the technologies they use to deliver that platform to the client base and the advisor. And I'd say thirdly is really the understanding of asset managers in a traditional sense, but also the larger private asset managers, private asset managers, seeing the opportunity, making very large investments into the segment. If you read the earning announcements of Schroders, BlackRock, Apollo, KKR, Carlyle, all on down the line, their incremental investment as a firm is going into private wealth. And you see it all over their websites, you see it in what products they're launching, and you see it in the fundraising that they're reporting on. For the private equity team here at Schroders Capital, 6 years ago, our private wealth business was negligible, less than 5% for sure. Today, it's between 20 and 25% of our annual fundraise, and our annual fundraising has doubled in the last 5 years. So you can see the scale of that opportunity set is really coming to bear, not just in the United States, but offshore.
Thank you, Lee and Lisa. So next, we're going to talk about opportunities in the market. And we're very, very fortunate to have assembled a diverse panel of investors on here. So can each of you on the investment side, so Michael, Greg, Lisa, and Lee, and we'll get to you, Laura, in a bit, but can each of you explain on the investment side how you determine which sectors or regions present the best opportunities in the current market? And we'll start with Lisa.
Thank you first. So on the best opportunities on the secondaries market where we play, right now, over the past few years, because of the lack of distributions in private asset classes, specifically private equity, but venture capital obviously seeing that pain as well, the best opportunities we're seeing today is really LPs looking to generate distributions from their private portfolio. They typically would hire an intermediary to run a process to figure out kind of what part of their private market portfolio would generate the best pricing and sort of the best size to get to what they want to get to in terms of that desire for liquidity or desire for distributions. And so in our market, we see both these LP-leds, so LPs selling a portfolio of companies or funds, that's an LP-led, and then we also do what the market, it's a sort of a growth area in the market these days on the secondary side, is GP-leds. And what GP-leds mean is a GP comes to us and say, I want to offer liquidity to all of my LPs in my fund. So ultimately, as a buyer, we're still transacting with other limited partners, but the difference between LP and GP-led, on an LP-led, we're buying from one seller, but multiple funds. And then on the GP-led, we're buying from multiple LPs, but typically one fund or sometimes even one asset. And so if you hear of single asset continuation vehicles in the news, that's what a GP-led single asset continuation vehicle is. So those are the two type of opportunities that we're seeing the most amount of growth in the secondaries market. And in terms of stats, I'll just throw out there, this year we expect total secondary volume to be about $140 billion across private equity, venture capital, a bit of private credit secondaries, a bit of infrastructure secondaries as well. So when I started after the financial crisis in 2010, that number was like 10 billion. And so this market has grown tremendously over the past few years. And then most recently, because of the lack of distributions by LPs, it has caused more sellers to come in and sort of get some kind of pricing on their private market portfolio.
And actually, in our data, we're seeing that secondaries are expected to grow at a 13% CAGR, the fastest subset of any strategy over the next 6 years. So thank you for that, Lisa. Greg?
Yeah, absolutely. And thank you very much, Shifra, for the opportunity to be on the panel. And thank you all for joining me on the stage. The Next Investors makes growth equity investments in the technology companies that are focused on the financial services industry. And this is the institutional and capital market side. So a lot of the trends that we're talking about today, a lot of trends of like all these things are growing, and the panel before us on all the AI, all of the tools that make all of that work, that enable financial services market participants to actually use that, to get that insight, to see that, to implement those solutions are provided by companies that we like to invest in. And if you look across all of that space, really, I think the big trend here is this increasing complexity driven by products, driven by competition, driven by the desire for managers to deliver alpha is increasingly being enabled by third-party technology providers. So in the past, you might build something yourself as an institution. You'd have a large IT infrastructure, and that would be building new products, writing code, and that is less and less the case, and more case that you need the interoperability and you need the ability to be dynamic that you get with third-party technology solutions, and that's what we're looking to provide. And just for some examples now, it's broader things. It's a situation of how can I get a non-technological person to do something that would have required a technology professional before and deploy quicker to a business analyst, and how can I get things like I can take in a lot of information, but then I need to execute separate. How can I combine those things? Those two major trends are driving a lot of the technology spend, because of the added efficiency and the ability to audit and go back and say to the regulators, like we heard in the prior panel, how did I do all this? Like, can I actually show you that I did all this? It used to be done manually, and now you need more automated ways to doing that. And those are the technology companies that we think are going to be successful as these trends continue.
Thank you. Michael?
Sure, thank you. So Moray Asset is a multinational asset manager with 600 plus billion AUM in 20 different countries. So you can imagine that all this strategy are here. So there's probably someone in the organization managing something like that for us. Where I sit in kind of the full spectrum is on later stage venture growth in a generalist format. So think about things from a more macro perspective. And when we think about where we're interested, we look at categories that we think are going to drive material value in the global economy going forward. And we've had a whole panel on AI. I can talk until I'm blue in the face about all the different areas there. I think the one thing that how we think about this is maybe a little bit different is that we tend to be a little more patient, where when you're investing into something that can have such an obvious transformative effect, when you're just riding the hype train, that's where bubbles are built. And when bubbles are built, ultimately there are some really great companies that come from this, because the companies that are actually driving the category, and we deem them category winners, are the ones that accrue 90+% of the value from said category. So to just throw anything at something that has the word AI in it can sometimes find you in trouble and will likely find you in trouble, but actually dissecting, being patient, and figuring out which of these companies is actually innovating and driving forward where the category is going and infiltrating into kind of sub-markets that also have a big enough kind of market opportunity is where we spend most of our time.
Thank you. Lee?
Sure. So from a market opportunity standpoint, SHTR Capital and its private equity business is very global in its framework, about 19 billion in assets, and we have professionals in States, Europe, and in China and Singapore. And so we look at the entire global private equity marketplace from venture to buyout across each of the investment types. And so we do have a relative perspective on the areas that we find more attractive than others today. And I think we're coming into a period now where the markets are beginning to wake up a bit and look at particularly the buyout segment marketplace, and especially the lower middle market part of the marketplace. So the corrections that's developed in the market over the last, say, 18, 24 months has provided us, I think, with a very attractive entry point to deploy capital in lower middle market buyouts in the States as well as Western Europe, less so maybe in Asia. And then on the venture side of our business, we're mostly focused on seed and early stage investing, and to a lesser degree later stage financings. We're very much focused on technology, particularly AI investing in the States and Europe, to a lesser degree in China because there's obviously some troubling dynamics going on in China. But we do have clients in Asia with strong interest in China. There's a tremendous amount of value in China today, given the flight of capital. But it's hard to stomach from this seat in New York to do that in the liquid asset class. And so I think the markets have settled out over the volatility of 22 and corrected themselves in 23 and into 24. And we see the seeds of opportunity developing themselves for the coming cycle before us.
Excellent. And you mentioned China, so I have a question for Laura. So based on what you've heard, and given you've had previous experience in M&A advisory as well, but also all your regulatory experience, what are some things that fund managers ought to keep in mind when they're selecting opportunities where there may be some restrictions, China, technology?
Sure. So actually, it was quite good timing for the panel today that Treasury issued a new rule just last night regarding investment in China. So last year, President Biden issued an executive order that will prohibit certain U.S. investment in Chinese sensitive technology sectors and require notification of certain other transactions. So Treasury issued the final regulations for that EO last night that will come into effect on January 2nd. So here, the focus is on more active capital that provides management expertise, access to markets, and other intangible benefits. Private equity funds, VC funds, and operating companies have clearly been in the crosshairs, while publicly traded securities and investments in ETFs and index funds will be accepted. So what this means is that funds with U.S. general partners will be prohibited in investing in certain Chinese companies that undertake activities with respect to semiconductors, quantum computing, and artificial intelligence. And then certain other transactions will be required to be notified to the government for them to collect information to potentially take further regulatory action. So with respect to the technologies, more advanced semiconductors are subject to the prohibition, but pretty much the whole semiconductor supply chain falls under the rule. Quantum is focused on prohibitions. There's not so much cross-border investment there. And then the wild card has been AI, because as we all know, that's difficult to define. So Treasury has tried to focus the prohibitions on technologies that are targeted for military or intelligence end use or developed with certain computing power, but the notification provision is still rather broad. And although notification is certainly better than prohibition, that will result in compliance costs. Certain US LP investments through foreign funds will also be covered. US funds that have controlled foreign entities in third countries will have to be sure they comply. And then US persons who are on investment committees, board members, officers, and directors will have to recuse themselves from these kind of decisions in third countries. So we've been helping a lot of clients prepare for that with recusal policies, beefing up due diligence procedures, and updating fund and other documents. then I'm happy to discuss SIFIs at some point as well.
Absolutely. Well, thank you so much. So we've all talked about these amazing opportunities and where you're looking at on the go-forward basis. But the reality is we've seen valuations, and there's been concerns on asset valuations and sluggish transaction activity. So just some data from Preqin. We actually ask investors a few times a year, institutional investors, and we survey them on their perspective on how accurately they believe managers are valuing portfolios. In 2022, 65% of the investors in our survey believed that portfolio companies were significantly overvalued. In 2023, that proportion dropped to 45% of investors, so indicating a more confident outlook. Now, the current climate that we're in, the transaction activity still remains muted. The number of transactions we saw in Q3 of this year is down 20% from Q3 of 2023. And 45% lower than the peak in 2021. Our data also shows a slowdown in exit activity, particularly for vintage 2015 funds, resulting in a backlog of unrealized investments. And what we're predicting is that the pent-up supply may lead to a significant influx of assets in 2025 entering the market, and that could impact valuations. So what signals, and this will be for Michael and Greg, what signals do you believe could effectively unlock the stalled deal flow in the market? And what types of transactions, both entries and exits, do you anticipate will emerge as leaders in the first 6 to 12 months following a deal resurgence? Michael?
So in the technology space, more so than pretty much any category of this matters for valuing any company, growth is a material impact on how you would value a company. So if you think about what was happening from 19 to 21, the ZIRP era basically masqueraded a lot of growth. There was a lot of free money out there that was flowing through to a bunch of companies, everywhere from software is a kind of enterprise software is a huge example. So when these companies are growing extremely fast, everyone's excited for what the opportunity can be and is willing to pay up because the time to actually grow into that valuation theoretically is relatively small. When the growth stops and these companies are well capitalized, and make matters worse, a lot of these founders took a lot of secondary sales to line their own pockets. The need for liquidity or need for an exit basically doesn't exist. Who wants to force the exit? The founder who's going to have to fire all their employees and get nothing for it. The investors who are going to have to mark down their books and go to explain to their LPs why this company is worth less than what they paid for it 6 months ago. So ultimately, what happens is these companies are afforded time to grow out. And we're starting to see opportunities there. And I think to your question about where the exits come from, the companies that actually were able to maintain or reignite that growth. And there are probably a handful of 5 to 15 companies that, if I mention the technologies companies' names, everyone would recognize already, have already been kind of soft prepping for an IPO. I don't think that that is necessarily the end-all, be-all for all these companies, because a lot of the companies that had raised in a time frame will never hit the growth rates required to hit those valuations. And then you have continuation vehicles, other forms of liquidity, or eventually, the zombie company that just functions because they don't know what else to do with themselves.
Yeah, I think growth is absolutely critical to that story. I think as growth investors ourselves, obviously what we're looking for is to generate our returns when companies have top line growth. And I think the way that we've focused on that is really in our market, in our segment, the strategic sale is the critical exit path for us. It's by far the majority. And that presents kind of two kind of very interesting subjects. One is that we're less dependent upon the market multiples and cycles. We're less dependent upon an IPO cycle, but we're more dependent upon our companies actually executing two things. One is actual top line growth and product market fit. And I think that's kind of what these things unlock that way first, right? Instead of just like broadly, oh, now everybody's going to go public or everybody's going to get acquired. It's going to be the companies that execute that best first will have that best opportunity and more of it. And I think that's in our market, that's just kind of the dynamic that we focus. And the other one is just simply scale. When we make investments, the companies are in that kind of smaller stage, and so the same amount of growth rate leads you to an exit valuation that is more acceptable to acquirers. So selling a company for $300 to $500 million is a lot easier than selling one for $2 billion, almost no matter what it does. And so I think that you see that kind of start in those shifts, and that those parts, I think, probably come first.
Yeah, we're
can
seeing
I-
the mid-market strength as well.
No, I was going to say, I can't let a valuation question go unanswered by what the secondaries market observes on valuation, because when you think about secondaries, the first thing people think about is, okay, what is a discount that I'm buying these private markets asset at? And that discount is really a reflection of, your point about confidence in the underlying GP's valuation. So just, again, this is sort of generalization, but when we think about the buyout asset class, typical discounts these days are in the 5 to 10% range. So, 90 to 95 cents of underlying GP valuation. On the growth side, that discount widens and it's a bigger range, maybe in the 20 to 30% discount. And then when we're looking at a venture capital fund, it widens even further, maybe in the 30 to 50% discount. So the type of assets that end up trading on the secondaries market, I think, is a reflection of the views, the confidence of the underlying GP's valuation. So that's point number one I want to add. Point number two, I think the previous comment is really about growth. If you remember, if you go back sort of right after COVID and you think about what happened to just US companies in general across buyout, growth, and venture, you first had inflation, which compressed margins. And then interest rates started to rise, which means companies then ran out of cash. And then I think when you think about last year, we're starting to see some slowdown in top line growth. So no matter what type of company you are, you have these three factors that are impacting your ability to use cash to grow, either through acquisitions or just kind of reinvestment back into your company, into your CapEx. And you have now a potential slowdown in growth. And I think the latest macro forecast from BlackRock in the market is the U.S. economy is somewhat still resilient, but there's undoubtedly a bit of a slowdown in growth. And so I think it'll be interesting to see how valuations of the underlying GPs evolve to reflect these three factors that has now crept into the ecosystem that is impacting financial performance. And whether you're talking about an exit through an IPO, an exit to a strategic, there's also a third path, obviously, which is exit to another sponsor. I think there are a lot of growth companies that get bought out by the next large growth investor, the next larger fund. And then obviously now you have continuation vehicles and sort of LPs driving some of that distribution. So I think it's a fascinating valuation of the underlying GPs and what it ultimately trades at on the secondaries market is sort of a fascinating trend and topic to observe over time.
I just want to add one thing on top of that. So you're starting to see segmented markets where others on the panel focus and where I focus, and where I'm focusing is still on the venture growth. And a lot of this baggage that exists with these companies is something that, quite frankly, I don't want to deal with. Right? There are other people on this panel better suited to deal with the structuring and restructuring of these companies to make sure that they continue to survive and make somebody money along the way. That's why a lot of the focus for me and a lot of the other people in venture are around artificial intelligence, because a lot of these companies have been started in the last 3 to 5 years. They haven't had to deal with some of these hurdles and are running straight towards a growth market where, so this was said to me early on in my investment career, try to invest in something that can touch as many areas as possible. And there's not a thing that you can think of that AI will not touch in some way, shape, or fashion. So it's a question of how broad can you go and how focused you have to get. And there's obviously different strategies to kind of capitalize on that. But the reason that you're hearing about AI funding in the news, especially on the venture side, is because a lot of these companies are unencumbered with all this other legacy baggage from raising at valuations that no longer make sense in 19, 20, and 21.
Perfect. Okay, so now we're going to shift to capital concentration. The fundraising market has been extremely difficult, as we know, in the last few years for all the reasons that we're familiar with and some that we discussed. And one of the market's distinguishing features has been the concentration of capital. So with 2023 marking a year where the 25 most successful fundraisers collected 41% of the capital. And given this added strain on fundraising operations, even for larger managers outside the top 25, many face significant challenges. The pressure is more pronounced amongst the mid-sized, small, emerging managers and even long-tenured managers who are large, but not mega. And Preqin noted that a similar trend of capital concentration in the hedge fund industry towards following the financial crisis, which led to the rise of the multi-manager or multi-strategy model, exemplified by Millennium and Citadel. So they employ semi-autonomous pods of star portfolio managers, while the central organization manages compliance, risk, and capital raising. So in this context, and this question is for Michael and Lee specifically, but others can certainly weigh in. Do you see this model emerging in the private equity arena? And if so, what private equity-oriented version, what might it look like? What factors are influencing this shift? And if not, what are the reasons behind the differences? So starting with Michael.
Sure. So having worked at several large institutions, I've kind of seen this play firsthand, and Moray itself kind of functions in a similar fashion, right? I manage a very specific strategy that acts as the kind of global venture growth strategy for the broader organization. And I think when you're thinking about kind of large scale investing, it's kind of a tale of two cities where you have to have some type of brand recognition or resources in order to get into, especially on the private side, super competitive deals. If the old adage, your fund size is your strategy, is really true, if I had a fund size a tenth of the size, I would be scouring the blocks right now, just running around looking for founders probably before they even came up with their idea, because that would be the most effective way for me to generate returns. And that's something that somebody in my seat that has to write a larger check just doesn't have the time or capacity to do. So as we start to have concentrated pools of capital, and we already talked about going towards retail investing, that's because the top kind of family offices or institutions are allotted for, right? They already have a GP or LP problem on who they're allotting capital to, so now you're starting to go retail, and that's who would typically go towards a smaller GP. So I would think that this would continue to play out, and these larger organizations will just figure out ways to create fund sizes that make sense for whatever strategy they want to deploy, and then hire people to build out those teams internally.
Okay, Lee?
Sure. I mean, for fundraising, fundraising is always hard. I mean, good periods, bad periods. It's highly competitive, and it's never easy to secure that next commitment from a client. That said, the stat around concentration here in 2023, over the years through cycles, you clearly see that in times of risk off, that the willingness of investors to pursue a smaller fund, an emerging manager, or what have you, is clearly less likely. And so consequently, it does drive capital concentration toward the more branded names out there, the more institutional platforms. And so consequently, you're going to see that dynamic. And I would expect that will begin to wane as the markets begin to settle out here in the back half of this year post-election and into next year. That said, though, clearly the larger managers, Schroders Capital included, has a multi-strategy approach to private assets in particular. And within private equity, we're one platform with many strategies within our platform. And I think the key thing here is that there are several types of firms out there that are pursuing multi-manager. You have the large global asset managers like a Schroders Capital that has a large traditional business that sees the growth opportunity within private markets and clearly is making a very strong strategic commitment to that segment and making a huge investment to succeed there. And that's borne out with great success over the years. You have the private equity manager who's grown successfully and established a national global brand saying, hey, let's leverage this brand for other strategies. And you see them adding strategies, typically direct investment oriented, but also coming into the markets of a BlackRock or ourselves and trying to do things like secondaries and what have you, but looking to expand that brand into other strategies. And that's not going to stop. We mentioned in our first question the growth of private wealth. And I think, unfortunately, the growth in private wealth doesn't bode well for the smaller manager, to be honest with you. Regulation, scale, the size that you need to have to get on a platform to get access to capital really doesn't bode well to the smaller manager. And I think that's going to unfortunately play out both in good times and in bad times, because there's a real institutional barrier out there with many advisors to take on a smaller fund, just given the risk reward for their platform, because they don't have the resources to conduct a due diligence like a large endowment might be able to do, and so on and so forth. So I think the proliferation of multi-managers is going to continue. The concentration, particularly in private wealth, will definitely accentuate itself in the coming years. But that all said, there's plenty of opportunity. It's a very big, diverse marketplace out there for emerging managers to come out, innovate, be aggressive, and apply their skills to a specific strategy and generate unique return profiles for those managers those investors able to capitalize on that.
Yeah, I think if I could just add one thing quickly, I think there are two things. One is I think that the one major difference between the pod strategy and how it might play out in private equity markets is fundamentally the liquidity, right? Those managers can rebalance. They can rebalance across the pods. They can adjust to changing risk environments macro, which is very, very difficult to do with illiquid assets. So I think there will always be that fundamental difference. And the other question about kind of larger managers to smaller managers, I completely agree. I think the larger kind of private wealth will force a kind of structure that looks like kind of like in some ways a hub and spoke, where you have these kind of liquid or semi-liquid strategies played out in the larger managers, and then you pick and choose where you want to add alpha with smaller, more focused strategies. That one is now, that kind of strategy can play out better when you have the technologies for these semi-liquid markets that have really come to pass in the last couple of years.
Great. All right, so now we're going to switch to one of my favorite topics, data and investments. Now, we know that the private markets landscape has transformed significantly in the last 10 to 15 years. There's a lot more complexity. Fund managers that played in one asset class are expanding into others, and I believe you alluded to that, Lee, when you were talking. And we're seeing more complex structures, semi-liquid vehicles. So this is resulting in more diverse and demanding investor landscape. And so the traditional methods of operations via emails and spreadsheets are really rendered obsolete. So given all of this, what data tech challenges do you encounter on the investment side or operationally? And Laura, feel free to chime in as well. And what have you done about it? And for everyone actually here, why don't we start with Lisa?
So on the secondary strategy, I described one type of deal that we do is LP portfolios. And so there are literally deals we would do. One deal would have 10 funds, and each fund has 10 companies. So you're talking already about hundreds of companies in just one deal. And we do call it 30 deals per fund. So if you look at our last fund, we had over 1,000 companies. And so the challenges of being able to analyze a portfolio, price it, but then the same challenge that an LP would have after they invest in any of these funds and then want to see what they actually own. Now that their portfolio is not just public equities, but it's a combination of public and private, and then what if an LP wants to actually just understand their healthcare exposure through both sides? Data and technology is going to be the solution in order to offer really first and foremost transparency into what somebody owns, and also kind of accuracy, I guess, of the capturing the data, because on the private side, unlike the public side, fund managers report in different manners. I mean, there are regulations that happen that try to standardize some of this, but depending on which fund manager you're investing with, depending on what strategy, there's just different levels of data and data consistency across all of this reporting. So I think when you think about an investor, starting with an institutional investor and now more potentially retail investors who just want to see what they own, that in itself might sound like a simple thing, but it's actually a huge challenge. And again, on the deal side, as an investor, we deal with that sort of day in and day out because we need to price portfolios that are hundreds of companies, maybe even thousands of companies. So one of the things we've been investing in, clearly we bought Preqin. That was one of our large acquisitions in the private market technology, data and technology space this past year. BlackRock also owns eFront, and that's one of the largest private market investment technology systems that are used by our clients and frankly used by us, the business teams as well. And then when you think about the public side, we own Aladdin. And so at BlackRock, our attempt when we think about delivering investment products and solutions to our clients, it's very closely tied with how we bundle that with data and technology, and how do we combine both the public side and the private side to offer a whole portfolio view for our clients.
Sure. So, I mean, the use of technology within our practice has really been focused on building, scale within our organization. since we have professionals in every corner of the world, about 200 professionals in private equity in total, our focus has been looking to apply generative AI within our practice. So Schroeder started with its own version of ChatGPT about a year and a half ago. That's now been rolled out to all the employees. It gets updated every quarter. You utilize it for building slides. You pop in the data or the content that you can attach. But we also launched a product we call Gaia, which is for private equity specifically. And here it's for the analysts and the associates to throw all the due diligence at the application and spit out the first version of a memo that would go to the investment committee. It's version 1. It provides a lot of efficiencies as a version 1. It requires a lot of checking by the analyst, but you can see how it can really take a template report that would go to the investment committee and allow that analyst and associate to really focus on, so does this sound right? As opposed to copy, pasting, formatting, spell checking, so on and so forth. They're really focused on, am I getting the right content into this memo and portraying the right message to the investment committee and really reducing their time wasted in building that memo. And hopefully in version 2 and version 3, it becomes much more intelligent and helping us develop further analysis. So for us, technology application is about scaling the organization. And when it comes to the portfolio itself, it's about taking these applications and disseminating our portfolio information, not just the team that's focused on it, but the entire private equity platform globally, and then making it available to our clients, which obviously are located in all corners of the world. And so it's all about scale and efficiency for us.
Yeah. Oh, go ahead.
I'll also note that having that information on the portfolio companies also helps with respect to regulatory compliance, particularly where there's a foreign person, if they're making an investment in the GP or if it's a fund of one. CFIUS and the government would look at rights through to the portfolio companies. So as CFIUS is increasingly digging into these transactions, we're having much larger due diligence exercises where we're trying to understand whether there's sensitive technology or sensitive data in US portcos such that the transaction may need to file, or in some cases we reduce some of the rights to prevent having to file and allow the transaction to move more quickly.
And I think this entire part is really kind of core to our thesis, and which is all this stuff is becoming more complex, and you can't use email and spreadsheets to manage it anymore. Right? That's just the fundamental thing. And technology companies that can provide these solutions, even to on the CFIUS side, like how do I keep all that stuff and report it in a consistent way, as opposed to having to scour through a bunch of emails and cap tables and things like that. Is going to become more and more important. And as larger managers are looking to add strategies, you're a private equity fund and you want to have a private credit fund, your infrastructure is probably not built for that. And you could either build it yourself, you can buy something separate, or you can buy something that's going to integrate well. And those technology decisions are increasingly important in providing what is a more complex product to more customers. And that, I think, is what provides also a lot of an opportunity. And the software vendors that can do it need two things. They need technological expertise, but I think more importantly, they need domain expertise. They need to understand what those business problems are and not to deliver a technology. Like, I can't just deliver, hey, I've got AI, do you want to buy it? I need to deliver, I'm going to deliver you a business solution that reduces your trade requirements from this period to that period. I might use AI in the background, but what you care about is your trade processing costs went down. Those things are increasingly important, and I think that's a great opportunity for this space.
Yeah, I mean, most of what I would say has already been said. I think the one thing that I'll point out is for the public markets for a long time, your data and your data strategy has been your strategy. I mean, I started my career at BlackRock looking at the green package where, they were able to farm that out to pretty much every other asset manager because that's the best way to understand what you actually have and how to kind of analyze your trades going forward. Increasingly in the private markets, and not just for financial services, but for basically any business you own, it's going to be even more so that how you handle the data, how you structure it, it's going to directly impact how your business operates. And I've spent more of my time actually digging into those companies that are involved and kind of the companies cleaning, analyzing, storing that data and investing into those companies than actually doing it for my own internal business. Right? But that's the benefit of having 5 people on my team. I can get them in a room, we can still hash it out. But as you try to scale that, And as we try to take the global perspective and incorporate more feedback from our colleagues in Asia or India or around the globe, really how we store and analyze that data and kind of point out those first kind of insights that we could then start to peel back individually, that's going to have a more and more of a material impact, probably not just for me, not just for everyone on this panel, but for everyone in every industry around the globe.
Thank you. It's good for us at Preqin. All right. So I'm going to shift to secondaries. How can I not talk about secondaries? So Jefferies reported a significant drop in the average age of buyout funds sold in the secondary market, with 39% of LP deals involving funds of 2019 or later vintages. Then that's the first half of this year. And those funds are trading generally at smaller discounts than earlier vintages, which you would expect. Does this align with what you've been seeing? And given that funds with vintage years of 2019 or later are making investments during a time of record valuations, why do you think investors are willing to accept a reduced discount to acquire them?
There's a lot to unpack there in terms of the duration of what is being sold versus kind of the ongoing opportunity set. I think when you think about the duration, one of the comments I made earlier is private companies staying private for longer. And so there's going to be a natural trend that you see of some of these fund vintages when normally it might take 4 to 6 years to invest in a company, get your value creation that you need, find the right opportunity to sell at a hopefully increase in multiple to generate your 2x or 2.5, 3x if you're investing on the growth side. It's just going to take longer now to get to that exit case. So it's not surprising that what we're seeing is, secondaries market started with a little bit of a tail end cleanup kind of mindset, but today people are actually selling recent vintages or 2, 3, 4, 5-year vintages as part of their generating of the distribution and liquidity. So that's kind of point number one. And two is you're starting to see cycles. I have a feeling that in some of these 2019 to 2022 vintage funds, they may start to look like the 2005 to 2008 vintage funds in the sense that it just took longer. The market is still quite competitive, even though, when you think about the lack of fundraising and smaller fund sizes, deal environment is still very competitive to find the best companies. So it's taking longer to deploy the capital. And then IRR just kind of sneaks up on you before you realize. And when it does, it's very, very hard to course correct at that moment in time. So my expectation is that there will be some funds in that 2019 to 2020 vintage where, in 5 more years, some of them may not be at their carry or may not hit carry. This is probably more prevalent in buyout because on the growth side, I think some funds actually don't even have a carry hurdle. But on the buyout space, I do think you're going to see a little bit of that cycle repeating of some of that kind of, crisis fund. And then on the last point, I think we think on the secondary side, you can buy high quality companies wherever it sits. So there might be a really good company that's been sitting in a fund, a GP's fund for many, many years, but then there's something that's happening in the ecosystem or in its industry that's causing an inflection point. And if that is the right way to invest by buying in it through a secondary, that's the way we're gonna, buy into it. If the best way to invest into a really good company is when it just got invested and there's some LPs that are looking to, their unfunded commitment is too high and they want to sell some recent vintages, we'll buy it that way too. So I think when we think about our investment philosophy and our investment strategy, it's just we're pretty flexible in terms of how we get access to these companies, whether growth, buyout, venture, credit, whatever the kind of company, and we're just kind of very flexible how we get through it, either on the secondaries market or on the kind of direct side.
All right. So Lee, will you close us out? Because we have 1 minute.
Sure. So, from a secondary standpoint, we also cover the marketplace of GP-leds and LP stake transactions. We are predominantly focused on the GP-led segment of the marketplace, probably 90% of what we do. It's really a function of our overall focus on, seed early stage venture on the venture side and smaller funds on the buyout side, where our ability to really leverage that relationship and source GP-led transactions, because we know these companies in the portfolios, we're able to watch them grow within the funds, and then obviously there's usually a good reason why the sponsor wants to hold that for a continuing period of time, but nonetheless, their clients, their LPs are looking for liquidity to some degree. And so we're very happy to step into that marketplace, buy that one asset that we've been tracking for several years, and be able to hold it for another 3, 4, 5 years if that's the opportunity set in front of us. And so for the last 10 years, we've done about 100 GP-led transactions, and we've proven to ourselves that that's been the most compelling risk reward for us in the secondary marketplace. And it's a growing part of the marketplace. There's obviously debate as if it's going to eclipse the LP stake marketplace. We don't really care. We know that our platform's growing. We have these relationships, and that's our opportunity set to really capitalize on secondaries.
I want to thank all the panelists for your amazing insights today. With that, we'll pass the mic.
Thank you.